Hello, good evening, everyone. Welcome to today's event where our CIO, Stephanie Leong, will be taking us through the most recent reoptimization of our StashAway portfolios. So my name is May. I'm part of the client experience team in StashAway, and I'll be assisting Steph to moderate today's event. So before I pass the mic on to her, I'd just like to start by sharing that we're live on both Zoom as well as YouTube, our StashAway's YouTube channel, sorry. So depending on which platform you're on, first of all, thank you so much for joining us this evening from wherever in the world you are. If you have any questions throughout the segment, please feel free to use the Zoom Q&A button you see at the bottom of your screen if you're streaming via Zoom. Otherwise, if you're watching us on YouTube, feel free to use the chat box feature you see on the side of the screen, and we will get to your questions at the end of the segment. Okay, so without wasting any more time, I will pass the mic on to Steph. So, Steph, over to you.
Thank you very much, May. Can you hear me okay? Just mic check.
Yep, sound good.
Can you hear me? Okay, great. So welcome everyone to our Q2 presentation. Basically, it coincided with a recent reoptimization that we did. And tonight's title is Putting Cash to Work. So as always, we work hard here at StashAway trying to invest with you and also put your money to work. But I think tonight's title is especially titled Putting Cash to Work because of the regime change that we're seeing. And in a moment, you see how we're actually putting even more cash to work given the new regime. So let me just start the presentation. So for tonight, we're going to have a two-part presentation. Number one, or the first part, we're going to be talking about, just very quickly, some of the portfolio reviews for StashAway year to date. And part B will focus on the actual ERA reoptimization itself, a quick walkthrough of what ERA is for those of you who are new to the platform, and also what the reoptimization actually means in terms of asset allocation changes. And then lastly, we'll touch upon some of the ongoing improvements to ERA and just get, get all of us to understand ERA a bit even better. Just before I begin, I'd like to spill the beans a bit and actually talk about some of the key takeaways that you will walk away from tonight's presentation. So let me just go through these points. First of all, I'm happy to report that our general investment portfolios have posted solid and positive returns in 2023. So on average, our general investing portfolios in US dollar were up 11.8%. And they continue to do quite well in 2024. So they were up 3.6% on average as of end of March. Our ERA investment framework actually indicated a shift of economic regime from stagflation to inflationary growth. And that is the reason, we're having this webinar to explain to you what's going on. And basically, the difference between a stagflation and inflationary growth regime is that we're also happy to report that growth is actually coming back to the macro environment, and therefore ERA portfolios are putting cash, which is a defensive asset, to work to generate additional returns. The fourth item is that we have updated some of the benchmarks and risk management metrics on ERA, and we'd like to actually give you some updates on that. And then lastly, just looking ahead, we expect further recovery in growth, given that we just entered the inflationary growth regime. However, inflation may persist, and these have implications, of course, not just for StashAway portfolios, but for your investments, and also, I guess, in terms of how you think about the world as well. So without further ado, let's go into the portfolio review. This chart actually shows you the Q1 returns for general investing portfolios on the StashAway platform. These are ERA managed portfolios, and as you can see in different currencies, GI portfolios have all posted positive returns. If we focus on the US dollar portfolios, on average, the StashAway portfolios have returned 3.6%. This compares quite favorably versus our same risk benchmarks, which on average returned 2.5%. So that represents an outperformance of 1.1%. In other local currencies, the StashAway portfolios have returned even higher, given that the local currencies have actually depreciated versus the US dollar. Here is a chart that shows you in a bit more detail how our different asset allocation portfolios actually performed. So you can see that our absolute and relative performance are quite pronounced for the low risk portfolios. These are due to our allocations to cash and gold. And as you know, year to date and in 2023, actually bonds underperformed versus other asset classes. So our under allocation to bonds actually help us to outperform our benchmarks. For the high risk portfolios, they pretty much perform in line with benchmarks, despite a more kind of conservative positioning. This is due to our allocations to gold and Japan, and both have returned very, very decently in the past 12 to 18 months. For non-US dollar portfolios, we have slight underperformance in these high-risk portfolios because of the lower US dollar exposure compared to our benchmarks. But again, as you see kind of in the previous slides, in local currency terms, we have actually made up for these under allocation to US equities from the currency exposure. And also, I guess these numbers are updated as of end of March. Now, April has been a choppy month for equities. So again, in a more choppy month, ERA portfolios actually outperformed the benchmarks. So our relative performance actually improved by 1.5 to 1.8 percentage points as the market pulled back in the previous month. Just a very quick note, if we kind of zoom out a little bit over the past 12 months, our GI portfolios also posted solid positive returns and also outperformed the benchmarks on average. So on average, in US dollar terms, our general investing portfolios were up 10.8%, and this compares favorably also versus the benchmark. Just to show you kind of how, I guess, StashAway portfolios have done in the kind of inflationary regime. So this chart here shows you the portfolio returns of both StashAway general investing portfolios and the respective same risk benchmarks throughout the period starting from Jan 2022. And we picked this period because this was the time when we actually detected a regime shift from lower inflation to higher inflation. So as you can see here, both StashAway portfolios and the benchmarks also experienced quite a lot of volatility because stocks, bonds, gold, crypto, everything kind of went down as inflation was rearing its head. However, what we'll point out here is that during this very volatile period, StashAway portfolios have actually managed to have lower drawdowns compared to the respective benchmarks. And in the bounce back, actually, StashAway portfolios bounce back just as much as the benchmarks did. So on average, we still outperformed the benchmarks by 5.6 percentage points throughout the period. So now we're actually saying that we're exiting this kind of stagflation period and going into inflationary growth regime. So our next part is basically talking about this latest change. But before we do that, I'd like to give everyone a quick walkthrough of what ERA is and how do we use ERA as StashAway to manage your portfolios. So what does ERA stand for? ERA has 4 letters, and these can be divided into 2 parts. The first 2 letters, ER, stands for economic regime. So what is an economic regime? Basically, it's about kind of where we are in a macro cycle. So if you think about things like GDP growth or inflation, these actually dictate, changes in these dictate where we are in the global cycle. So the reason why we use economic regime, because at StashAway, one of our core values is that we believe that top-down systematic approach using these macroeconomic data can give us a very, very good insight into how different asset classes perform during these different periods. And we validate this belief by actually running very rigorous backtesting or kind of looking at historical data of how these different asset classes perform during the different regimes. And we found meaningful relationships. Second part of ERAA is, of course, AA, and AA stands for asset allocation. So at StashAway, I mean, we don't try to pick stocks, so we don't try to kind of make a decision on whether Apple will outperform Google, or if, I mean, Amazon is better than Nvidia, but we focus actually on the asset class itself. So for example, how much do we allocate to equities versus bonds versus gold? And even within equities, how much we allocate to US technology versus Japan, et cetera, et cetera. So the reason why we do that is that historical studies have shown that actually asset allocation make up the majority of portfolio return variability rather than selecting the stock itself. So just to kind of go down one layer of fundamental principles that we employ at StashAway and when we created ERAA. So firstly is the principle of risk first. And I mean, this is actually quite apparent if you log into the app and you try to select the right portfolio for you. Basically, if you look at all the different StashAway portfolios, they are classified by what we call the StashAway risk index. And it's a constant number that you select at the beginning of your journey with StashAway that basically dictates what is the risk that you're willing to take for a particular portfolio. And our job is actually to keep this level of risk constant despite these changes in macroeconomic conditions so that you don't have to worry about changing risk. Secondly, we focus on the best-in-class asset selection. Now, for us, it's really about selecting the best ETF that represents a certain asset class. So, for example, if you think about, oh, I want to invest in US equities, I mean, there are many different funds that you can use, right? You can use some mutual funds, you can use different ETFs, and even if you decided to use ETFs, there are many different ETFs. There's like ETF from Vanguard, from BlackRock, et cetera, et cetera. So all these ETFs can be quite different. And if you don't have the right data, if you don't have the right tools, sometimes it's very, very hard to analyze one from the other. So at StashAway, what we spend a lot of time on is actually analyzing these different ETFs. We actually have a scorecard that looks at certain attributes of each fund and determine what is the best in class and only present the best in class to our clients. Thirdly, we highly believe in a systematic and data-driven investment strategy. Now, some funds are managed by a fund manager, and this fund manager is, of course, a human being. And human beings oftentimes have emotions, right? I would have emotion, you would have emotion as well. And a lot of times, I mean, these emotions actually get into the way of managing portfolios effectively. And if you think about kind of the world's greatest investors like Warren Buffett or George Soros, I mean, they also have a human running the investment, but they have very, very rigorous rules. And these investors are able to stick to these rules very, very religiously. So almost like a computer. So then, I mean, our idea is why do we need to rely on a human being to make these decisions when we can actually outsource this or build a lot of systems to track data real time and to help us to make decisions on a very, very rational basis. So that's why, I mean, we have built ERA to be a very systematic and data-driven framework and a set of different systems to help guide us in our portfolio allocations. So for example, when we say, oh, ERA is, or StashAway portfolios have, let's say 11% allocation to a US bonds, then, I mean, basically that means our system actually says that, I mean, this is the right allocation for US bonds for that particular risk point. Lastly, on top of the system, we also have a rigorous risk management framework. So risk management actually covers a lot of different things, but that includes some risk metrics, which I'll talk about later. And then also, I mean, of course, the model works 99% of the time, but you still need human oversight to make sure that it doesn't go haywire, or if you have this 1% of chance where the model hasn't seen such occurrence before and spit out unreasonable outputs, then, I mean, you need some, I guess, seasoned professionals to review the outputs and vet it before it gets passed down to our customers. So we have an investment team, which is led by myself and also other professionals. And we also have an investment committee with very, very well-seasoned and experienced investors to ensure that the output of the models are kind of are vetted and reviewed before we push it to our customers. So I talked about asset allocation, and I raised the point that actually, I mean, the majority of portfolio returns comes from asset allocation, not security selection. Here is a few reasons or data points to support that kind of statement. So first, let's look at this table here. I mean, this table actually lists out the different types of funds that tracks different types of indexes in the S&P in the US equities. Now, the numbers on the right-hand side shows you the percentage of the funds actually underperforming the benchmarks in different time periods. So going from 1 year, 3 year, 5 year, 10 year, 15 year to 20 year. So we kind of look at the 20-year horizon. Actually, 94% of active funds underperform the benchmarks in the past 20 years. The last year has been a bit better, but still, I mean, 75% of the funds actually underperform the respective benchmarks that are tracking, I mean, just kind of broad US market indexes. I mean, why is this a problem? Because if you pay these active fund managers more fees to try to bet stocks, try to bet if Apple is going up more or Amazon is going up more, you're not getting any return on the extra fee that you pay these active managers. So when we first started StashAway, we actually didn't intentionally say, oh, we just invest in ETFs. But given this type of data that we see, and also given that ETFs are a lot cheaper than active funds, for example, a US broad market ETF these days, I mean, charge as little as 0.02 percentage points. So that's way, way, way cheaper than an active fund that still charges 1.5 to 2% in annual management fee. So that is why, I mean, as StashAway, we focus on ETF rather than active mutual funds. Also, there are other academic studies. I won't go into this, but basically, I mean, the conclusion from this seminal study from 1986, so not a new study, it's actually very, very well established, is that asset allocation actually explained, again, 93.6% of the variation in a portfolio's quarterly returns. So again, showing that asset allocation, not security selection, actually matters more. So here I'd like to kind of change or talk a little bit about the different types of asset allocation. So broadly speaking, in the investment industry, there are two types of asset allocation. So one is called strategic asset allocation, SAA. The other one is called tactical asset allocation, TAA. And I mean, both actually try to, these are both frameworks, both very, very well adopted frameworks to come up with investment portfolios. However, the two of them actually differs slightly. So I'll go through each one of them. A strategic asset allocation, SAA, is typically a longer term asset allocation. So it is a very, very personalized asset allocation framework. So for example, a wealth advisor would ask you, what are your risk preferences? What are some of your kind of life cycle events? For example, if you're saving up for a kid's education, or are you saving up for retirement, or do you have special preferences for things that you like to invest in? For example, are there thematics that you care more about, or do you want a ESG version of, do you want only ESG compliant investments? So these are very, very much based on your own personal preference, and therefore it doesn't change, right? It only changes when your own preference changes. And this is actually akin to selecting the StashAway risk index on the StashAway platform, or selecting whether you want to do general investing only, or do you want to do general investing with an ESG tilt, or do you want to add some thematic allocations to your StashAway portfolios. So this is the strategic asset allocation part. And ERAA is basically a tactical asset allocation overlay on this SAA, on a strategic asset allocation. Because it's tactical asset allocation, as its name implies, it tries to actually understand where we are in the macroeconomic cycle and position your portfolio accordingly. So it also is, it doesn't trade in and out every day, right? It's not a very active strategy, but it makes these very, very important shifts in your portfolio, let's say once a regime change. And these regime change happens perhaps on an annual basis or even like 2-year basis. So these are medium-term allocation portfolios. These are consistent with the economic cycle. So basically, ERA itself is a technical asset allocation built on top of your selection on the StashAway platform on what risk index you want to choose or on which portfolio you want to invest in. So hopefully, this gives you another kind of, I guess, lens to look at what ERA is. So as I mentioned, in a technical asset allocation model, basically the model would try to understand where we are in a regime and position accordingly. So why do we think that tactical asset allocation is an important overlay on top of the strategic asset allocation? So this chart here has a lot of dots. You can ignore most of them. And I guess the idea of this, or the key takeaway from this chart, is that so each asset class, given a particular standard deviation or risk, would have a different expected return. Typically, when you think about risk and reward, they are in proportion. So for asset classes that have higher standard deviation, meaning higher risk, they would give you potentially higher return. So on the top right-hand corner, for example, you see emerging markets. So this is a very good example. Emerging markets carry a lot of risk, but potentially it could also give you a lot of long-term return. And if you look at the bottom left-hand chart side of this chart, there's cash, right? Cash actually does not have a lot of standard deviation. In fact, I would argue that this should be almost zero, but it gives you some return, right? Right now, it gives a higher return, but a few years ago, it gives you almost zero return. So when you put together these different asset classes that have low correlation with each other, then what you can arrive is a portfolio with a higher return for the given level of risk. Because why? These asset classes all move up over time, right? They all have positive return. However, if they are not correlated with each other, if they don't move in tandem with each other, then your mark-to-market up and down would be mitigated by the different movements in these different asset classes. So using this concept, strategic asset allocation can be constructed by using some form of optimization technique, and this is called efficient frontier. So you can see there's a green kind of cross there. This is a portfolio that sits on the efficient frontier, which means that for a given risk, for a given standard deviation, this is the best portfolio that we can get, the best return that we can get by mixing different types of asset classes in different proportions. So this is a standard SAA model, and this is very, very standard. So all the robo-advisors actually use the same methodology. So we also use this in our optimization. So what is the difference of StashAway, or what's the difference of ERA compared to just a generic strategic asset allocation model? So we have actually, the ERA actually sits on top of this strategic asset allocation model to give you the allocation. So I'll just walk you through this slide. So on top, you can see that there's a modern portfolio theory, which is the efficient frontier. So what is the key insight here, or the key kind of added benefit? The key benefit is that you should diversify, right? Diversification actually gives you more return for the same level of risk. So that's all good. That's well practiced everywhere. What ERA does is that ERA understands that different asset classes actually behave differently under different macroeconomic conditions. So, for example, stocks perform much better in a growth environment. Bonds perform much better in a recession environment. So using this insight, using this kind of model that we built for ERA, then we would combine modern portfolio theory, we combine efficient frontier with ERA regimes to arrive at the optimal allocations under different macroeconomic conditions, which are the ERA allocations. So this is basically a top-level understanding of what ERA does. I won't go through this. We have actually gone through that already. So with this kind of very, very quick overview of ERA, let's look at in real time what's happening, right? We've just triggered a reoptimization. So what does that actually mean? I'll just go through the key points here, and we'll dive into each one of these points in later slides. First of all, based on the latest economic data that our ERA model tracks, we are basically seeing the shift in the cycle again from stagflation back into inflationary growth. So this triggers a reoptimization for ERA managed portfolio on our platform. This includes all the ERA managed portfolios, for example, general investing, for example, thematic, for example, DRB, ESG, etc. In terms of how asset allocation is different, we're basically putting your cash to work, right? We are allocating more to equities, and also we improved our allocations to high yielding bonds. We also, within equities, have more tilt towards cyclical sectors. Lastly, we also introduced some new ETFs to the StashAway ERA universe to allow ERA to express certain views. This include an equal weight S&P ETF, an ETF investing in defense and aerospace, and also an ETF that provides target exposure to India. So to start with, ERA has changed its regime, and this is a chart that I've shown again and again. It helps everyone to understand where we are in the cycle. So for those who are new to our platform, basically we divide the macroeconomic cycle into 4 quadrants, and these different quadrants are characterized by the differences in growth and inflation. So if we start from the top left corner, which is good times, and as the name suggests, growth is actually high and inflation is still low. So this is a great time for companies to generate very, very good profits. Hence, this is a regime where stocks tend to perform the best. Now, as the economy move into more overheated condition, inflation start to go up. And this was actually remember a few slides before, we were saying that we went into this sort of inflationary growth regime kind of in 2022. When we're starting to become, when inflation starts to become a problem, central banks tend to have to tighten policy, meaning that they increase interest rates, for example, and that actually triggers slowdown in growth. In December 2022, that was the last time we did our reoptimization. What we were seeing is that the economy has shifted from inflationary growth down to stagflation. So this is when growth actually was contracting. Now, after almost 15 months, we're seeing a return back into inflationary growth again. So when we track our data, we're seeing growth above thresholds and recovering. So this is where we are in the global cycle. So just to give you another graphical depiction of what we mean by actually growth coming back. This is a chart that shows you our growth indicators, which we track on a real-time basis. And if you look at the left-hand side, this is basically the 50 line. The yellow line is the dividing line, right? When the indicator is above 50, it means that the economy is in expansion. When it's below 50, it means that it's contraction. So recently, growth has actually returned back into expansion. However, if you look at inflation, inflation is still fairly high. So here we've shown the PCE number, the US inflation number. On the left-hand side, you can see that there's also a yellow line, and that's the Fed's 2% target. So the Fed has stated very, very clearly that they want to get inflation back around 2%. And even though inflation has been cooling off, it's still quite some distance away from that 2% target, which is why inflation tracked by our data is also saying that it's still too high. So given the change in regime, what are the actual allocation changes? Within equities, we are increasing allocations to equities across all the portfolios. Why? Because when we look at equities returns and risk across the different regimes, equities tend to have a decent return during inflationary growth regime with lower risk. So, because we're trying to keep the risk constant, so we can actually allocate more to equities without changing the risk of the portfolio itself. For bonds, within bonds, ERA is actually shifting also to high-risk assets. So these would include high yield bonds and also emerging market bonds. Thirdly, for ultra short treasuries, so these are basically cash equivalents. ERA had been overweight across all different portfolios since beginning of last year, since December 2022. And given the shift in regime, I mean, we're now paring back the allocation to these ultra short treasuries. They have actually done very, very well for our portfolio, protecting our portfolio, and also generating very, very good yield, right? US short dated, ultra short dated yield is still above 5%. However, we're seeing better potential returns for other risky asset classes. Hence, we're paring back the allocation to these ultra short treasuries. Lastly, for gold, most of our portfolios actually will see a reduction in gold because gold also serves as a defensive asset. However, gold ERA still maintains an overweight position on gold because inflation is still fairly high, and gold is actually a good hedge versus the inflation risk. Here is a graphical depiction of what are some of the changes. So you can see these different percentages. The purple ones represent equities. So you can see that across all different portfolios, we've increased allocations to equities. And in terms of the of gold, for example, I mean, we have maintained still a overweight to gold, but have pared back these allocations. So I spoke about different asset classes actually performing differently under different regimes, and here is some data to support that that statement. Here you can see that there are two bars. So the kind of bluer line, the bluer bar represents S&P return under the 4 different regimes, while the yellow bar represents the return of long-dated government bonds in these different regimes. Today we're in an inflationary growth regime where, I mean, S&P has typically returned close to 8% per annum. But I mean, longer dated US government bonds have actually returned negatively in the past when we had this inflationary growth regime. So this is clearly because bonds are basically safety assets. So for example, they perform a lot better when the economy actually goes into recession, as you can see on the left-hand side. But today we're not there yet. Therefore, I mean, we have actually maintained an underweight allocation to these longer dated US government bonds, but we have increased allocations to riskier assets. In terms of geographic allocations, here are some of the, I guess, key allocation highlights. ERA has been overweight US over Europe, and it continues to do so. The reason being that growth data in Europe still lags behind the US. So even though we're seeing a recovery in global manufacturing cycle, that's predominantly driven by the US rather than Europe. Secondly, in terms of Japan, ERA has been overweight Japan since December 2022, and it's still maintaining an overweight there. Basically, I mean, ERA is still seeing strong undercurrents in terms of Japanese domestic growth, and also very, very likely that Japan can emerge from its 30-year-long deflation. In terms of emerging markets, ERA maintain an equal weight in China, but ERA has assigned an overweight to India, adding up to 3 percentage points of additional allocation in the high-risk portfolios. In terms of sectors, ERA has also increased its focus to cyclical sectors. So these include cyclical consumers and industrials. To make room for that, ERA has actually pared back its overweight allocation to healthcare. From a structural perspective, I mean, the investment team is also still very positive on healthcare, but from a regime basis, I mean, ERA is saying that this regime actually favors the cyclical sectors more. That's why there's a shift in allocation. For tech, ERA has been overweight tech in December 2022. However, because of significant outperformance of tech, and ERA actually hasn't moved its allocation. So today, I mean, ERA is actually a market weight tech, and it maintains that market weight in our new allocations. So lastly, I'd like to talk a little bit about some of the new asset classes that we have included into ERA universe. First of all, we have included an equal weight S&P 500. And the key reason behind this is that given the significant rally in the big cap stocks, and for example, like everyone has heard about the Max 7, the concentration risk in a market cap weighted headline S&P has gone up a lot, right? So if you look at the bottom chart here, this plots the top 10% stocks by size versus the entire market. So today, the top 10% market cap stocks actually make up 75% of the market caps, which is very, very concentrated. So it has only happened, I guess the last time it happened went all the way back to 1929, 1930s, and also during the dot-com bubble. So given this, I mean, increasing concentration risk, we're introducing an equal weight S&P, which actually takes a broader and less concentrated exposure to the US market. And ERA has allocated up to 6.2% in high risk portfolios to this equal weighted S&P. And I guess one of the key reasons why ERA has allocated to this equal weighted S&P is also because in a macroeconomic cycle where growth is actually coming back, the money flow or kind of the investment returns actually favor a broader market rather than just focus on a few tech companies. This chart actually shows you the relative performance of the equal weight S&P versus the headline S&P, which is the white line. So the white line, when it goes up, it means that the equal weight is outperforming the headline. When it goes down, it means that the equal weight actually underperforms. So as you can see in 2023, equal weighted S&P significantly underperformed the headline S&P. And it has shown some pretty good correlation versus the yellow line. So yellow line is actually the US leading growth indicator, the ISM index. So as we expect the ISM index to tick higher, you can expect also that the equal weight S&P to start to outperform the headline S&P again. The other ETF that we have added to the universe is actually a US defense and aerospace ETF. This acts as a hedge versus increasing risk of geopolitical conflicts. I'm sure, we all read about the news in terms of wars in the Middle East and also, the ongoing conflict in Ukraine. I guess the fact is that this kind of geopolitical risk is not going away. So, we can hedge these kind of risk by different type of assets. For example, when gold is a good hedge, oil is potentially a good hedge as well. We're introducing this defense and aerospace ETF as a direct hedge, given that these are companies that are most involved or benefit from higher geopolitical concerns. So basically, this is a ETF that make up of industrial companies, and from a ERA kind of regime perspective, I mentioned that ERA would favor the industrial sector. So this is why ERA has also selected this ETF into our current allocation. It has allocated up to 3% in our high risk portfolios to this particular asset class. Lastly, on India, ERA is also overweight on India, given its compelling growth story. Data continue to be very, very strong. We have been market weight India through our emerging markets ETF, but we like to actually allow ERA to do a even more targeted overexposure to India. That's why we're including an India-specific ETF to allow ERA to better manage its allocations. Also, one great benefit of Indian equities is that historically it has had a low correlation with global equities, so it adds to diversification benefits. For India, ERA allocates up to 3% specifically to India for higher risk portfolios. Here is a chart that we've shown in our Sell Insight, just to show kind of how, I guess, historically, India has done very, very well in the past 20 years. So the yellow line here is MSCI India, which actually has outperformed even S&P 500 in the last 20 years. And in our Sell Insight piece on India, we actually argue that going forward, the future is even brighter for India, given its structural story in terms of not just population growth, but also in terms of stabilization and inflation, and also investment in infrastructure. A lot of foreign investors are going into India these days, and we think that these are accelerants for India to grow even faster in the coming decades. So that covers what's actually going on in the portfolio itself. And lastly, I'm going to cover a few ongoing improvements to ERA. First of all, we have actually updated our benchmarks. So as I mentioned, each StashAway portfolio actually has a same risk benchmark. Same risk meaning that, for example, if you choose a SRI 36 portfolio, we would have a sort of a benchmark that has also a 36% drawdown risk over the 12-month period. So basically, I mean, this helps us to or help our investors to understand what are the risks that you're taking when you select a particular StashAway portfolio, because these are benchmarks that don't change, right? These are kind of if you think about in the very beginning of the presentation, I talked about the SAA and the TAA. So basically, I mean, these are the SAA, the strategic asset allocations that you can make in comparison to the ERAA TAA allocations. So historically, we have included equities and bonds in our benchmarks. However, reflecting on some structural allocations, we like to update these to include gold and also ultra short government bonds. So ultra short government bonds are essentially the cash-like equivalents, the cash-like asset classes. So we're including these ultra short bonds in our lower risk portfolios to reflect a structural allocation to these cash-like, asset classes. And then for all of our portfolios, we actually have included gold officially as part of our benchmark, so that you can expect to see gold in all these allocations. If you look at the graph here at the bottom, you can see clearly, I mean, how the different benchmarks are constructed using the different combinations of equities, bonds, gold, and these ultra short bonds. So also, in addition to updating our benchmarks, we have actually enhanced our risk management metrics over the years. Here, I mean, at the very top, sits actually the StashAway Risk Index. And I've spoke about this StashAway Risk Index SRI multiple times, because this is really a basis on which we build our portfolios. For those of you who are new, this is basically a number tagged to each portfolio that shows you the maximum drawdown over a 12-month period in a kind of 99th percentile probability scenario. So easier to walk through an example. So for example, SRI 22 is a medium risk portfolio. What does that mean? That basically means that over any 12-month period, your maximum drawdown risk is 22%, 95% of the time. And I guess in other terms, it means that there's only 1% chance that your drawdown would exceed this 22%. So it gives you some sort of, way to think about what is the risk that you're taking. For example, if you have a 36%, you have an SRI 36 portfolio in a very, very risky, or in a very, very bad kind of market environment, your portfolio actually may go down to 36% from top to bottom. And if you select a high risk portfolios, you need to be prepared that, I mean, this is sort of a drawdown risk that would happen. But of course, I mean, history tells us that whenever there's a market drawdown, if you invest in asset classes, if you invest in broad ETFs and stay invested, they will bounce back. The key is really not to panic during that drawdown and to be able to recover and reap the benefit of the subsequent rally. So we've seen that multiple times already in recent years. For example, during COVID, US stocks went down 30% in 2 weeks' time. Some of the StashAway risk indexes or some of the StashAway portfolios also had drawdowns, but they were all in accordance to the SRI. So this gives you a peace of mind saying that, okay, if I'm risk averse, I chose SRI 12, then I mean the SRI that particular portfolio drawdown would not be 36%; it would be only 12%. So that gives you the peace of mind, so you can actually ride through these market drawdowns. On top of this SRI, we have also introduced other frameworks or other techniques to help to manage risk, to make sure that the allocations are within a certain risk parameter. The first one is a tracking error. So for example, I presented some of the benchmarks before, and tracking error basically tells you how much active deviation you expect for the benchmarks. So for the lower risk portfolios, the tracking error is actually lower. And for higher risk portfolios, the tracking error will be higher. So this makes sense, right? Because if you have lower risk, you want less variability. Whereas if you are comfortable with high risk, then you would let the model actually take on more active risk in order to generate better outperformance. Also, we've imposed a maximum allocation to single sectors or countries. This actually limits any potential overexposure to a single asset class, because I think inevitably, some allocations, like the model is not 100% perfect. So sometimes some allocations work better, sometimes others work less well. The key is to ensure that when some allocations actually don't work as expected, the risk from these allocations are actually well contained. Lastly, we also have beefed up our investment committee advisors, and we've actually invited three very renowned investment professionals to join our investment committee as advisors. I won't go through each one of them here, but all of them actually brings together decades of experience at very well esteemed institutions like BlackRock, GIC, etc. So with that, we bring together not just the expertise of the investment team, but also the expertise of our investment committee advisors. Lastly, I'll just do a quick recap of tonight's key takeaway, and then we can open up for some Q&A. So firstly, general investing portfolios have had a very, very solid year in 2023. So we were up almost 12% on average. They continue to do so in 2024, up 3.6% on average through March, end of March. And during the month of April, where market was a bit more choppy, we still outperformed benchmarks. Secondly, our ERA investment framework now indicated a shift from stagflation to inflationary growth, which means that we're putting more cash to work, right? We're putting actually your portfolio to a slightly higher gear and risk to take advantage of this environment. We have updated our benchmarks and our risk management metrics to ensure strict governance, as I've updated all of you. Just a bit of looking ahead, given that we just entered the inflationary growth cycle, we expect inflation to remain quite high, gradually coming down, but further recovery and growth, which is great for risky assets. So perhaps I'll stop here and start to take questions.
Yep. Thanks so much, Steph. That was extremely in-depth. So we have a few questions rolling in.
Okay.
Before I get to them, let me just remind the audience, if you're joining us on Zoom, please feel free to use the Q&A function button you see at the bottom of your screen. If you're joining us on YouTube, please feel free to use the chat box you see at the side. So let me just start with a question that relates more to ERA. So, Steph, just now you mentioned that we're continuously improving ERA, making sure that, our model is functioning well in accordance to what the market is telling us, right?
Mm-hmm.
So we have a question here from Thompson. He's asking, how responsive is ERA in reacting to and I guess predicting the market environment?
Yes.
Do we do any back testing?
Yes.
And do we actually, would we ever consider sharing results?
Yes. So, I guess the entire ERA framework is built on top of rigorous data review and analytics. And this is basically backtesting, looking at historical data and how the different regimes actually change the behavior of different asset classes. And also, of course, we need to study the regime itself. So what constitutes a inflationary growth environment, which data sets actually give us the best indication of these changes in regimes. So I would say that, the data sets that we use are monitored on a real-time basis. ERA's reoptimization window is on a rolling monthly basis. So on during the beginning of each month, we actually review all the data that we collect during the month to make to actually see whether ERA trigger any kind of shift in regime. The reason why we choose on a monthly basis when we build a model is because if you look at data that is too frequent, there's too much noise. And if you look at data that is too sparse, then there's a significant time lag. For example, GDP, right? GDP itself is a very, very good data. It's basically it's not subject to a lot of revisions and there's not much noise. However, GDP only comes out on a quarterly basis, and also it's a lagged indicator. So by the time GDP comes out, the market has digested probably 90% of the data value. So there's not much value in terms of using the GDP in a model. However, if you look at some of the weekly data, that can also be quite noisy. So we tend to kind of converge on a monthly kind of frequency because that's the best cadence that we've found. Secondly, in terms of like, do we predict these data? We've actually also run some pretty rigorous backtesting on our own kind of model, and we've tried to simulate, for example, if we were to have perfect vision, let's say we were able to perfectly kind of predict what's going to happen 3 months down the road, and we reoptimize our portfolio, I guess preemptively. That actually didn't help our portfolio returns because like the market actually doesn't look that far ahead. So what we found is that if we react kind of in real time, meaning that within a 1 or 2 month window, I mean, that gives us actually the best result. So this actually gives us confidence that we don't need to forecast too far into the future. And a lot of times, if you rely on forecast numbers, it's very, very inaccurate because these forecast numbers are done by human being. There's a lot of biases, like company earnings, for example. We all know that some of the analysts have a lot of biases into these company results. So that's why using real-time data that gives you a very, very good picture and very good model return results.
Okay, thanks for the insight, Thompson. I hope that answers your question. Okay, so moving on, we have 2 questions from Jay, which I'll consolidate into one. So previously you mentioned in the new regime, in our new following our reoptimization, we're now overweighting emerging market bonds as well as high yield. So he's asking, for emerging markets, are we favoring sovereign or corporate bonds? And for high yield, does this primarily refer to developed market high yield corporate bonds? So that's the first part. Yeah.
Yep.
Okay. So I'll let you answer the first part first. Yeah.
So first question, yes. I mean, we are by emerging market bonds, we're mostly referring to emerging market sovereign bonds for a few reasons. Number one is that, I mean, these tend to be in the emerging markets category. We already find that these government bonds give us good enough yield. And then secondly, because so a lot of these EM bonds actually are denominated in US dollar. So we actually prefer the US dollar denominated emerging market bonds. When you go down into the corporate side of things, the number one, the quality of the issuer goes down. Number two, I guess the currency exposure is less focused in US dollar bonds. So that's why, I mean, we're actually doing EM government. Secondly, in terms of high yielding bonds, yes, those are developed markets, a lot of them in the US.
Okay, and the second part of the question is more related to stocks. So Jay, just for clarity, we don't do single stocks. I believe here you're probably mentioning equities ETF. So now his questions are for equities ETF specifically. Are we overweight value or are we overweight growth?
So like the way we think about our allocation, so we don't specifically model for that, but I would say that basically we were underweight value in our stagflation allocations. And right now, I guess we're much more kind of neutral value, given that the regime has shifted to inflationary growth. So, I mean, that's why when you look at, for example, the equal weight S&P, it has more of a value tilt than the market cap weighted S&P. So in terms of, for example, emerging markets, that's more value than growth. So I think it's basically raising our allocations to value, but we don't explicitly have like an overweight to value.
All right. Thank you so much, Stephanie. Jay, I hope we answered both that question. Now let's move on a little bit to the US side of things. Ian has a question relating just to our outlook. So what is our view on the latest US GDP and non-farm payroll, which is much lower than expected? And does ERA still define this as growth, or is it going to be a recession?
Okay, so maybe I'll focus on the non-farm payroll because I mean GDP is actually not a very, very good metric to see in real time what's going on. And I guess I'll just offer one comment on GDP before I move on. So if you look kind of one layer deeper into what's driving GDP, the disappointment in GDP is basically the net export number. So part of GDP is actually net export. Basically, if you export more than you import, that adds to your GDP. I think in the latest number, actually, the import actually rose a lot more than what the market was expecting. That's why it dragged down GDP. However, if you think about the reason why import was surprising on the upside was because the US consumer is actually quite strong. So even though on headline, it looks like GDP is surprised on the downside, actually, if you kind of look one layer deeper, it's not as bad as the headline suggests. Secondly, on non-farm payrolls that came out last Friday, again, I mean, the numbers surprised on the downside, but so the market was actually expecting, I think, 240,000 job growth. The final number came out to be around 180, so 60K kind of jobs, less jobs created. If you look one layer deeper again, where does that 60K job come from? Actually, almost all of that come from government hiring. So if you look at government hiring in April, that basically was about 8K, but the previous 3 months have been around 60K. So the government, for some reason, actually, I mean, put a freeze on hiring in April, and that was the major surprise to the market. So I think if you look at unemployment rate, it ticked up slightly, but it's mostly a rounding thing as well, right? It basically went from I think 38.3 to 38.7. Therefore, when you round that, 3.83 to 3.87. So when you round that, it went from 3.8 to 3.9. So I don't think there's anything to be worried about if you just kind of dive a little bit deeper into the actual numbers.
Thanks, Steph. And also going forward, in terms of outlook, which regime change do you think is more likely in your opinion, right? Just based on current data, forward-looking data, do you think we'll be going back to stagflation, a recession, or perhaps a low inflation, high growth
Yes.
Regime as well?
Yes. So I think if you look at the historical precedents, so we've also studied like how likely is regime shifting from one to another, right? I mentioned that there's a cycle that goes from good times to inflationary growth to stagflation to recession back into good times. That is a typical flow. However, I mean, ERA can also flow the other way, right? You can also go from, as we've just seen, you can also go from stagflation back into inflationary growth. And indeed, I mean, this was actually what happened in the 1970s. So during the 1970s, actually, ERA also shifted back and forth these two regimes a few times. And I guess if I drawing some parallels between now and then, it seems like ERA could actually gyrate between these two regimes for some time, just like in the 70s. Now, of course, I don't have a crystal ball, and I mean, I could just make my best guess. And when the regime happens, I mean, ERA will tell us. But I mean, just for reference, there is a historical precedent that we get kind of stuck on the right-hand side for quite some time.
Yep. Thank you. Thanks so much, Steph. So earlier on, we also spoke a little bit about, some of the slight underperformance of non-US portfolios. So a question here from Kit Leong. He's asking, so for non-US portfolios, with the lower SRI return beating the benchmark, and for higher SRI, the return is inferior as compared to the benchmark. So given that we're doing a lot of improvements to our ERA framework, does the improvement made in ERA help to improve this?
Well, I guess, I mean, all the improvement in ERA is with the goal of improving returns for our customers. So of course, I mean, I hope that these improvements actually help to improve returns. However, I can't say for sure whether or not it will, but I would mention a few things. Number one is the target currency exposure. So one of the improvements that we made over the years is to actually align our target currency exposure for non-US dollar portfolios closer to the benchmark. So, for example, today, if you look at the currency exposure for non-US dollar portfolios, the neutral weight is actually 50% US dollar exposure for bonds and 60% US exposure to equities. And before this update, the target exposure was actually slightly lower at around 40% for both bonds and equities. And we've actually made this change because we realized that the reason why, I mean, the non-USD portfolios have underperformed versus the benchmark in US dollar terms is because basically they systematically underweight US dollar. Although, I mean, they would give the local currency return, like the local currency is actually a better return because in a regime where the US dollar is appreciating, it means that in local currency terms, you would get more absolute return. It kind of, I guess, penalize the portfolio from a relative perspective. Therefore, I mean, to better align our portfolios with the benchmarks, we've actually adopted the benchmark weights to the neutral US dollar allocation. So hopefully this answers your question, because I think currency is one major factor contributing to portfolio returns for non-US dollar portfolios.
Thanks, Steph. And we actually have more questions on ERA. So here we have Gareth from YouTube asking, is there a possibility of borderline cases where indicators over a few months or weeks fluctuate and point towards different regimes? And at the same time, does our ERA model actually seek a minimum number of data cycles before actually confirming a shift in the regime?
Yeah, it's a very, very good question. And indeed, I mean, like data can be quite noisy from month to month, which is why we actually apply a rolling window. So we don't just look at 1 month's data, but we look at, I mean, several months' data. And I mean, I mean, from backtesting, I can't disclose like how many months that we use, but basically from backtesting, we determine kind of the most consistent number of months without sacrificing the real-time kind of, I guess, characteristics of being able to react to data.
Okay, thank you, Stephanie. One last question from Jay. It's more of a market-related question. So in your opinion, has a soft landing been achieved based on the current regime changed?
So I think, I mean, there's definitely different definitions of soft landing. But I think one of the key criteria for declaring soft landing, declaring victory, is that inflation actually comes down to more reasonable levels, which is basically around 2% that the Fed is targeting. And I think we've made a lot of good progress in second half of 2023, and that's why the market was actually cheering on the soft landing narrative. Now, in the last 2-3 months, I mean, inflation have come down much more slowly, and there are concerns in the market that inflation becomes sticky. Actually, I mean, this is one big risk that we highlighted a few months ago. We were saying that, I mean, the market has been too optimistic on inflation coming down. And beginning of this year, the market was actually looking for I guess 5 to 6 times interest rate cuts by the Fed by the end of this year, basically like calling out a soft landing scenario. And I mean, what we were saying back then was that because the inflation expectations are too optimistic, we don't think the Fed can actually cut 5 to 6 times. Now, fast forward to today, the market is now swinging in the other direction. Because the market is saying that is getting worried that inflation will start to come up again, and therefore the market has pared down its expectations for Fed cuts. Right, just 2 months or 2 weeks ago, before the jobs data came out, before the FOMC, the market was actually expecting almost no cut at all. So where does the market stand today? It stands somewhere in between. It says that, I mean, the Fed may cut 45 basis points by the end of this year. We think that, I mean, the Fed has actually communicated that they would like to cut 3 times. So, I mean, our base case is that 2 to 3 times of interest rate cuts is probably quite reasonable. But the market keeps gyrating their view according to the latest data. So I think this will keep going for a while until we see inflation kind of sustainably go below a 3% or 2.5% threshold.
So on that note, do you think a recession is still the base case, or have we actually moved away from that narrative?
So I think if we think about the next 6 months, the probability of a recession is fairly low. Reason being, number one, U.S. labor market, and actually not just U.S., but developed market still enjoys very, very strong labor market. And if labor market is strong, people actually are making wage increases. They have jobs. Like, you don't get a recession. Secondly, is that we actually see a recovery in manufacturing cycle, and that actually bodes quite well for emerging market or industrial economies like China and Germany. So already, I mean, we're seeing the Chinese equity market actually, I guess, recovering quite strongly on the back of this recovery in global manufacturing cycle. So I think that also helps US to mitigate some of the kind of risk of going into recession. So I think in a 6-month time horizon, is not a high probability that we go into recession. However, if inflation actually proves to be stickier and the Fed actually needs to raise interest rates again, then I mean that actually increases the chance of recession down the line. So let's say 12 months to 18 months. Of course, as I said, right, it doesn't increase your investment return by forecasting too far in the future. So I mean, we can make all sorts of scenario planning, et cetera, but for portfolio like public market investment, it is important that we actually monitor the data closely and react quickly to it.
Yep. Thanks so much for that, Stephanie. I think the one thing to also close off this with is, as much as we want to maximize returns for our users, it's also very important for our users to ensure that they are actually in the correct risk index portfolio for themselves. Ultimately, you need to ensure that you're also comfortable with the risk that you're taking, just to avoid sleepless nights. Let's just say that, because markets will always be volatile. On that note, thank you so much, everyone, for joining us this evening. I hope this was an informative session for you. We overran slightly by 5 minutes. Thank you so much again for spending your evening with us. And of course, thank you, Stephanie, for actually putting together this presentation and sharing your thoughts, as well as what the continuous improvement we're doing on ERA for our users. So on that note, again, thank you so much for joining us. If you have any further questions, please do feel free to reach out to us at support@stashaway.com. Our CX team is available to help you in any way we can. If you have more ERA-related questions for Stephanie and her team, we're more than happy to also take that and pass it on and hopefully give you an answer. So yeah, thank you so much, Stephanie, and thank you, everyone.
Well, thank you, May, and thank you, everyone.